Welcome to This Explainer. Today, we're basically stepping into the shoes of a financial detective. Whenever you look at a company's financial statements, you just expect them to be accurate, right? But how do we actually know they are? Let's demystify the two absolutely critical tools in the auditor's investigative toolkit: tests of control and substantive testing. So let's dive right into this. How do auditors actually catch fraud or, even just massive mistakes? Because behind the scenes of every trusted financial report is an auditor gathering sufficient, appropriate evidence. It's not just sitting in a back room and randomly pointing at receipts. Not at all. It is a highly structured process of risk assessment. The auditor's core mission here is to hunt down discrepancies and make sure the numbers match reality. But before we look at the tools, we really have to understand what our financial detective is up against, the villains of our story, if you will: audit risks. Auditors face the constant threat of material misstatements, and those are errors big enough to actually change a stakeholder's mind. They're fighting against active fraud risk, failures in a company's own internal controls, inevitable human errors, and just general financial reporting inaccuracies. The entire purpose of audit procedures is to reduce these risks to an acceptably low level, and they do this in two main phases. Let's start with Phase 1, checking the locks, otherwise known as tests of control. Think of this as checking the security system before you ever step foot inside the bank vault. In practice, a test of control evaluates whether the internal safeguards implemented by management are actually operating effectively. Simply put, before the auditor even looks at the actual money, they want to know if the company has built strong walls, installed good locks, and hired attentive guards. Now, this entire test of control phase hinges on one absolutely crucial pivot point. Can auditors actually rely on the company's internal controls? If the answer is yes, if those controls function effectively, it drastically changes the auditor's strategy. It means they might be able to reduce the amount of deep, heavy data testing required later on. So what exact locks are the auditors checking? Well, here are the common controls they test. First, authorization controls, making sure purchase and payment approvals are actually signed off by management. Second, segregation of duties. This one is vital. You want to make absolutely sure the person handling the cash isn't the exact same person recording the cash in the accounting system. Third, reconciliation controls, like matching bank statements to inventory. And finally, IT controls. This means checking user access restrictions and password controls. Because let's be honest, a company can have $1 million IT security policy, but if the accountant's password is password123, that control has failed. And that is exactly why we test. So how does this actually build in practice? Auditors don't just take management's word for it. They use escalating methods to test these controls. They start with inquiry, literally interviewing accounting staff about their approval procedures. Then, observation, actually watching employees perform inventory counts. Next is inspection, physically reviewing the signed approval documents. And finally, reperformance, where the auditor independently executes the control, like, say, recalculating approval thresholds themselves, just to make sure the system's math matches reality. Which brings us to Phase 2, counting the cash, formerly known as substantive testing. All right, once our detective has evaluated the security system, it's time to open the vault. This brings us to substantive testing. These are procedures performed to detect material misstatements directly in the financial statement balances, transactions, and disclosures. Notice the shift here. We are no longer testing the process, we're testing the actual numbers. The focus is directly on the financial information itself to detect material errors, identify fraud indicators, and really verify those account balances. The absolute crucial point here boils down to a single question: are the financial statement figures actually correct? This directly contrasts with our earlier question about relying on internal controls. Here, we aren't asking if the approval process was good, we're straight up asking if the final dollar amount is right. To answer that, auditors basically use two categories of substantive tests. The first, substantive analytical procedures. This is where the auditor looks for unusual fluctuations that require deeper investigation. They analyze relationships between financial information, like comparing current year revenue to previous years, conducting gross margin analysis, trend analysis, ratio analysis, the whole shebang. If revenue suddenly tripled but inventory levels stayed exactly the same, well, this analytical tool triggers a massive red flag. This second category is tests of details. Now, this is the manual, highly granular, evidence-based work. For cash testing, auditors get direct bank confirmations and perform physical cash counts. For accounts receivable, they literally send confirmations to customers asking, hey, do you really owe this company this amount? For inventory, it means physical counts and pricing verification. And for revenue, it involves examining individual sales invoices and reviewing contracts. It is a thorough, direct examination of supporting evidence. Next up, the interrogation, how the methods work together. In a real audit, these two methods are, well, they're heavily interconnected. Just look at the direct comparison here. The test of control evaluates effectiveness, while substantive testing detects misstatements. The focus shifts from internal processes directly over to actual financial balances. The main question shifts from are controls reliable to are figures accurate? And importantly, look at the timing. Tests of control happen continuously throughout the audit period, whereas substantive testing often takes place near the period end when the final figures are actually, ready. What's really fascinating here is the cause and effect relationship between them. Look at the first scenario. If a company has strong internal controls, meaning the locks are secure, the auditor assesses a lower control risk. This results in reduced substantive testing and greater audit efficiency. But in the second scenario, if the internal controls are weak or failing, control risk literally skyrockets. The auditor has to compensate by dramatically increasing substantive testing, using larger sample sizes, and performing way more detailed procedures. Basically, broken locks mean a lot more digging through the vault. Let's look at a real-world case file, the revenue audit. Let's ground everything we've discussed into a tangible example. How does an auditor tackle revenue? Step 1, they test controls. They verify that sales approvals exist, credit checks are genuinely performed, and management authorization works. Now, even if those controls pass with flying colors, the auditor doesn't just pack up and go home. No way. Step 2, they perform substantive testing. They still conduct revenue cutoff testing, inspect invoices, and confirm with customers. So the key takeaway here is that auditors rarely eliminate substantive procedures completely, even when controls are incredibly strong. The two steps always work in tandem to provide sufficient evidence. Now, both methods definitely have their pros and cons. The advantages of relying on tests of control are that it vastly improves audit efficiency, reduces unnecessary, tedious testing, and genuinely evaluates system reliability. However, the limitations are rooted in human nature. Controls can intentionally be bypassed by management. Human errors are always possible, and sometimes a control might look absolutely perfect on paper, but fail occasionally in practice. On the flip side, substantive testing has some massive advantages. It provides direct, undeniable evidence and detects actual misstatements. It strongly supports the final audit opinion. But the limitations are heavy. It is incredibly time-consuming, far more costly, and requires much, much larger sample sizes. If we only ever counted the cash and never relied on internal controls, audits would take forever and cost an absolute fortune. That's exactly why the balance between the two is so critical. Let's look at the future of the investigation. So where does the financial detective go from here? The goal remains exactly the same, obtaining reliable evidence. But technology is drastically changing how both of these testing procedures are performed. Modern audit trends are increasingly relying on massive data analytics, shifting from point-in-time checks to continuous auditing. We're seeing automated control testing, AI-assisted sampling that can look at whole populations of data rather than just small batches, and heavily integrated ERP audit tools. Which leaves us with a really fascinating, provocative thought to end on. As systems become completely digital and algorithms can analyze 100% of a company's transactions in mere seconds, will AI and automated control testing eventually eliminate the need for human substantive testing altogether? Will the financial detective one day be entirely automated? Or will we always need that human element of professional skepticism? It's a massive question for the industry's future. Thanks so much for joining me on this explainer, and keep questioning the numbers.